You could probably speak to this more than a lot of people. I'm sure foreign investors are wondering, what is the liquidity on these things?
Yeah. Well, actually, liquidity is not bad because if you look at the size of the China bond market, it is the third largest in the world, just slightly behind Japan and larger than Germany, France, and the Italian bond market. So definitely liquidity is better than many people thought.
How much of a reallocation do you think we could see when it comes to global portfolios now?
Actually, if you look at the foreign ownership, the China government bond segment is about 8% owned by foreigner. It's primarily due to reserve managers' investment over the last 5 years.
Right.
If you look at the overall bond market in China, it's only 2% owned by foreigners. So the credit market is still pretty much untapped.
It's mostly central banks, really.
Exactly.
Right?
If you talk to like US or European investor, they're very interested at the moment, but they have not been investing in the past. So I think there's still a long way for these global investors to go into this market.
Mm-hmm. All right. You just mentioned that liquidity is actually not that bad for government bonds and policy bank bonds, but other foreign investors have brought up that there are concerns about interest rate derivatives and liquidity of the run government bonds. So what are some concerns and issues that you think can still be resolved in this market?
I think one of the reasons for the less liquidity than other large markets in the world is because there are a lot of buy and hold investors. Like banks investors are the largest investor in the bond market. But I think with the inclusion, we will see more active investors going into this market, especially that will benefit government bond and policy banks bond.
So initially, we're talking about 350 or so securities here, and it'll be phased in slowly, 5% each month, right? 10 over the next 20 months or so. Knowing that schedule of how these will be included, how do you invest around that? What's the overall investment strategy to get to outperform the market, basically?
Yeah. Well, I think if you look at the macro picture right now, the good news for the China bond market is that growth is still slowing down, CPI still falling. But on the other hand, with the policy support we saw over the last few months, we should expect a soft landing in China economy and company earnings to stabilize and rebound sometime in the next 6 months. That means that credit will probably outperform. So I think a balanced portfolio would be good for investors. So don't focus too much on interest rate. So you should have a balanced portfolio with government bond and credits.
We tend to see Chinese bonds and stocks, you could argue, do their own thing relative to what you see for the rest of the market. And if you think of the correlations as well when it comes to Chinese 10-year bonds with treasuries, for example, we're not seeing that strong of a correlation as well. Do you think that we can expect things to strengthen those correlations, or do they actually stay as a good diversification trade?
Yeah, I think it will be a good, will still be a good diversification because China has become more and more a continental economy, so it'll be less affected by the global economy. If you look at export, less export is actually in the negative territory right now. Growth is now mainly driven by domestic consumption. So there will be some, the diversification benefit, I think, will still be there. And also, if you look at the longer term trend, the US has gone for a long-term, very long bull market for bonds. But if you look at China, if you look at the short-term interest rate, has been around 3 to 5% in the last 10 years. Any chance that interest rate will continue to drop? I think definitely yes, because with growth, the structural slowdown in growth, and the high saving rate in China, and the aging population, I think we're actually just at the beginning of a long-term bull market in China for bonds.
I think one point you just mentioned was quite interesting, is that investors should have a more comprehensive portfolio with government bonds, credit, as well as stocks. So I've seen a lot of strong debate over whether investors should focus on over the next year. So do you prefer bonds or corporate bonds, or government bonds, corporate bonds, or stocks? So what's your preference level?
Well, I think definitely both bonds and equities should trade much better than we saw in 2018. Like, if we look at the equity side, valuation is still relatively cheap, even after the rebound. And there's also a chance that we'll see better earnings and better growth numbers from China in the second half. So definitely there is some value, but we should be careful that the market actually has rebounded a lot. So in the next two to 3 months, if we don't see a good fundamental numbers coming out, there will be some volatility. But I think 1 to 2 year view, definitely I think there's still value. But on the bond side, definitely I would prefer credit over government bond because government bond you actually have dropped over 100 basis points over the last 12 months. There may be another 20 or 30 basis points,
right?
But that's all you get. But credit spread, especially I think lower weighted credit, there's still more room for credit spread tightening as the economy stabilizes.
This might be a boring question. It's a bit operational, but a lot of money is going to be flowing in, has been flowing in already. How do I hedge? I mean, can you trade futures, rate derivatives, that sort of thing? I mean, that's the next question, right?
Yeah. Well, in the domestic market, there's the bond futures, right? The 10-year bond futures, 5 years bond futures, right?
So it's not going to be a problem for foreign investors coming in. I mean, they have the tools that you would normally have, say, in other markets to be able to hedge that exposure.
Yeah.
One last question. If we have time, we bring up this quote. There was the Lombard ODA APAC CIO. He was a little bit wary about really kind of piling into this market. I just kind of want to read a quote that he mentioned here. He goes, in China, rules can change overnight. We need to have assurance and policy clarity first. And that's also the big topic of discussion between index providers and Beijing, I believe. In the end, it's about credibility and transparency. Do you think that there's still a lot of psychological barriers here and a lot of questions on whether just how involved the PBOC can be in this market too?
Yeah. Well, I think there are always questions about China. But my experience is that when investors start to invest in that market, their questions will start to reduce. So the thing is, it's a very different market. It's a very complicated market. So you need to go into that market to understand it. But I think with the size of the market and with the opportunities, the market you cannot ignore. And if you look at last year, there was outflow from different year markets. But there was consistent inflows into the China bond market as well as into the China A-shares market. Some of the ETFs we manage that are listed in US and Europe, we actually saw very strong inflows since Q4 last year.